Money is a universal language, but it's spoken with two completely different dialects. To some, it's a shield against disaster. To others, it's a seed for tomorrow. Understanding the divide isn't just about how much you have, it's about how that money moves. Two lives, same city, different outcomes. The difference begins with a mindset. Is money your emergency shield or your seed for tomorrow? Today, we break down the systems behind wealth. Welcome to The Wealth Architect. Let's begin. For the poor, money is linear. You trade time for a paycheck, and that paycheck is immediately consumed by liabilities, rent, food, and debt. It is a game of survival. The poor mindset, focus on earned income. Success is measured by working harder for a higher hourly rate. The rich mindset, focus on passive income. Success is measured by how many employees, dollars, are working for you while you sleep. Key concept, the rich buy assets, things that put money in your pocket, like stocks or rental property. The poor buy liabilities, things that take money out, like high-interest car loans. One grows your cash flow, the other starves it. Think in systems. Convert earned income into owned assets that produce cash flow. Automate the flow so your default behavior builds wealth. Let money move even while you sleep. Learn cash flow, not just income. Different dialects of money create different destinies. Own assets first. Shift the mindset, and the math follows. The vicious cycle: low income, high expenses, debt to bridge the gap. Interest payments reduce future income, and back to lower income. A trap. The virtuous cycle: surplus income, investment, returns and dividends, more surplus, larger investment, momentum. The secret is compound interest. As Albert Einstein reportedly said, "He who understands it, earns it. He who doesn't, pays it." Small, consistent contributions plus time beat sporadic, heroic efforts. Time is the lever. Start early, let math work. Reinvest returns to accelerate the curve. Exit the vicious cycle. Enter the virtuous one. Wealth creation in 2026 isn't about picking one lucky stock. It's about systems, rules, automation, and diversification. Low-cost index funds and ETFs form the foundation for most investors. They let you own a slice of the entire market with minimal fees. Lower fees mean more returns compounding in your favor. Keep it broad, low-cost, and boring, and let time do the heavy lifting. Use tax-advantaged accounts to keep more of your returns. Tools like ISAs, 401ks, and IRAs reduce taxes and boost compounding. Tax efficiency can be the difference between good and great outcomes. If there is an employer match, capture it. It is free money. Real estate can provide steady cash flow and long-term appreciation. Cash flow today, equity growth tomorrow. Private equity has higher barriers, but offers ownership in cash-flowing businesses. Know the risks, leverage, illiquidity, and the need for due diligence. Alternative assets are emerging: renewable energy, data centers, and AI-driven infrastructure. These sectors can offer durable demand and contracted cash flows. AI enhances efficiency, turning CapEx into predictable yield. Treat alternatives as a complement, not a core. Mind allocation, fees, and liquidity before diving in. Before you invest, heed the warnings. Emergency fund. First, never invest money you might need next month. Aim for 3 to 6 months of expenses in a liquid account. Kill high-interest debt. If your card charges 20%, no investment reliably beats that. Beware of shiny object syndrome. Avoid speculative trends and schemes. Expect volatility. Portfolios can drop 10 to 20% at times. Wealth is built by those who stay invested, not those who panic sell. Set your foundation. Then invest with discipline. Caution protects progress. Now, harness new tools wisely. AI is no longer just for Wall Street hedge funds. It is becoming the personal co-pilot for the everyday investor. Robo-advisors rebalance and harvest tax losses based on your risk tolerance. Predictive analytics scan millions of data points to anticipate market shifts. From satellite images to sentiment, signals emerge faster than humans can parse. AI algorithms and high-frequency trading execute in milliseconds, capturing tiny discrepancies. Quant models exploit patterns at scale, 24/7. Risk: be wary of black box algorithms. If you do not understand why a trade happens, you are gambling, not investing. Use AI as a transparent tool, aligned with your plan. Let technology serve your system, not dictate it. The gap between rich and poor is not just a bank balance, it is a cycle of habits. Shift from consumer to investor. Design systems that move money toward assets. Let time and compounding do the heavy lifting. Begin building your own architect for wealth today.